Senate banned trading on prediction markets for members and staff. Today, GOP Rep. Ashley Hinson introduced a resolution in the House to closely mirror the Senate version. While several lawmakers have floated bills this year to more widely ban the process, none have become law. CNBC and the Kalshi prediction market have a commercial relationship that includes customer acquisition and a minority investment. I'll send it back to you.
All right, earnings from DraftKings out just moments ago. The stock slightly higher after hours. We'll talk to the company's CEO about those results coming up on Overtime.
People still love the songs. They are attached to special memories in people's lives. Don Henley, Joe Walsh, and the Eagles return to Hotel California channel. Welcome to the Hotel California. I've got 50 years of stories I can't tell. Maybe I can now. Check into Hotel California now on Channel 105 and the SiriusXM app for a limited time.
Accredited investors, tired of the stock market roller coaster? Want to hedge your bets and looking for a smart alternative to grow your wealth? Ascend Capital Partners offers a real estate fund with annual target returns of up to 18% with monthly distributions, an attractive alternative to annuities without high fees or commissions. The fund invests in luxury, residential real estate projects across the country, and its proprietary high-tech platform streamlines every project, shortening timelines and increasing profitability. With a $100 million plus real estate portfolio and significant tax advantages, this fund can be a smart way to hedge your bets while receiving reliable annual target returns up to 18%. To learn more, call Ascend Capital Partners now at 800-775-9550. That's 800-775-9550. Or visit investwithascend.com. Investors should consider the investment objectives, risks, charges, and expenses carefully before investing. Target returns are not guaranteed, and past performance does not guarantee future results.
Did you know your life insurance is an asset you can sell? I'm Jay Jackson, CEO of Abacus Life. For almost 20 years, Abacus has been purchasing life insurance policies from seniors just like you. And at abacuspays.com, we've created a free policy value calculator so you can find out the worth of your policy in just seconds. There are no fees and no obligations. Get real value for your life insurance when you need it with Abacus. Learn more at abacuspays.com.
Ryan Reynolds here from Mint Mobile. I don't know if you knew this, but anyone can get the same premium wireless for $15 a month plan that I've been enjoying. It's not just for celebrities, so do like I did and have one of your assistants switch you to Mint Mobile today.
Visit mintmobile.com/radio. Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Feeling stuck in your job? Learn how to change careers with CNBC Make It's new online course.
Our tips can help you navigate any job change with confidence.
Take the first step. Register now at cnbc.com/career change.
Welcome back to Closing Bell Overtime, live from the NASDAQ market site. A down day for stocks, the Dow falling 300 points, or about 0.6%. Smaller losses for the S&P 500 and the NASDAQ. The Russell 2000, by far the worst, losing more than 1.5%. Software was a leader, results from Datadog and Fortinet leading the way. But chips were mostly lower, especially the red-hot memory names such as SanDisk and Micron. And check out shares of Rackspace soaring after signing a memorandum of understanding with AMD. The two companies say they'll work on the new type of enterprise AI managed by Rackspace and powered by AMD processors. Well, markets may have taken a breather today, but under the surface, things aren't looking bearish yet. Joining us now is John Colovis. He is Chief Technical Strategist at Macro Risk Advisors. Good to see you.
Good to see you, Mike.
So obviously markets kind of, I guess, regained the benefit of the doubt to a large degree, making new highs. Certainly the leadership of the AI trade got reasserted. Are we seeing some fatigue here? Are we seeing some stretch conditions? How are you reading?
A little bit of both, right? I think today, if you look underneath the surface, you see how small caps have wobbled a bit. You had a bit of an outside candle reversal there. You had your micro caps did the same thing. You saw part of semiconductors also come down a little bit. So you have a little bit of a wobble, if you will, but I don't think it's necessarily the end. It's a bit of a warning shot. Now, the risk here, if I can go with that, is that, as we know, as things go parabolic, they're not going to correct sideways. They're going to come down pretty darn hard. So what I'm telling clients these days is this, hang on loosely, right? And enjoy the trend, but be mindful of your levels in case, and we will eventually have a sharp pullback, and I think it will be over the summer months.
For semiconductors in particular, does it tell you anything about the nature of this wobble that NVIDIA, which had not been participating, is now participating? Is there a rotation within the sector to sort of the relative underperformers?
Yeah, I think that's actually a great observation. I think that's actually what could actually save the tape here, right? When you're confronted with a market with an RSI of 83, which is the Q, is very, very, very high. But NVIDIA is not. It's a middling momentum. I think you can actually look to the NVIDIAs of the world to kind of save the tape from actually falling completely out of bed at this level.
And in terms of the S&P 500, where do you think this ultimately has its destination? I wonder because, I was saying, a lot of people saying, even at the lows in late March, okay, yeah, it looked like you have a lot of the conditions in place, but it's nowhere near as washed out to where you springboarded higher last year after Liberation Day when you went up 40% in 6 months.
Right. So let's back up the track a little bit, right? So my view for the S&P for this year is 7650, okay? I haven't shaken that at all yet. When last time I was on, we talked about technical green shoots, all right? I was like, boom, I think the low is in, we're going to push up higher. And those technical green shoots create what's known as a good overbought condition. And in this environment, it's like very concentrated indices, which has been about the last 10 years. You don't fight momentum. When something's overbought, you embrace it, you hug it, and you ride it that way. So what do I think the market can go? 7650 before the end of the year. But this current leg, I can see the market getting into around that, call it 75-ish area before we roll over. And my guess is, the summer months we'll see a retest of the Q1 highs.
What does oil do in the meantime?
In the meantime, oil right now is sideways, okay? Depending on your contract, it peaks somewhere around 100, 110, it's sideways. First thing we need to see with oil is that it needs to break its 50-day moving average before you can move lower, and ultimately $80, then we can breathe easier. Until then, it's sideways. Now, longer term, and I've talked about this with you before on air, is I think oil's in a secular advance. It bottomed last year. It's probably going to go to 150, 200 over the next couple of years. But right now, which is more important about the wobbles, it's just consolidating. It's moving sideways. You break under 80, I think we can feel a lot better about risk. And I think at that point, breadth will actually start to improve.
And in terms of Treasury yields, it was kind of a kick save, right? You didn't go to 4.5 on 10s or anything like that. Is that also going to be kind of range bound and sideways for you?
Yeah. So I think interest rates are range bound for the time being. 4.5 being the ceiling or so. But I think the main chart to watch, and everybody's watching the nominals, it's the 10-year break-evens that are super important. Now, if you were to actually look at a chart, 4-year chart of the 10-year break-evens, it is a massive coiled spring. To me, I think that's the biggest risk here in the market. You break that out above 2.5, boom, inflation expectations are going to take off and the market's going to get crushed. So my guess is that the market is not going to pull back because of overvaluation. Things are overbought. It's some sort of macro-induced drawdown that comes. So I think oil could be part of it. Inflation expectation could be a part of it. A new Fed chairman usually brings in a test. I think that happens. And also, since last time I was on, I did a study on V-bottoms. V-bottoms typically don't see their first shakeout until about 5 to 6 weeks after the low. That gets us into the end of May, into June timeframe. What does that also line up with? The midterm election seasonality, which is the weakest of the whole 4 years. So I think we're getting close to some sort of shakeout, but I don't think it's enough to derail the bull market.
So let's say we do have that pullback that you're predicting, and then we go back to that level that you're predicting for the end of the year, 7650. Does the market composition, do the leaders look the same as today, or do they change?
Probably they stay the same,
okay.
Right? I'm in the camp of we're not going to see sustained broadening out until the next major bear market. So we're in a regime of concentrated portfolios, and indices are just going to be more of the same.
That was like the early 2000s.
Exactly right.
Once we peaked in 2000. All right, the 38 special mark. Hold
That's
on
right.
loosely, don't let go.
John, great to see you. Thank you. John Kalopos.
All right, ahead, shares of DraftKings moving slightly higher after hours as earnings came in above estimates. Monthly unique players came in below estimates. We're going to talk to the CEO in a first on CNBC interview next. And talk about a sky-high Wall Street debut. Shares of Hawkeye 360, which provides satellite intelligence services for the defense industry, soaring nearly 30% after pricing its IPO at $26 on Wednesday. It is the latest space company to go public ahead of the highly anticipated SpaceX IPO. Closing bell overtime. Be right back.
I burst into our factory basement office and yelled, "I finally found our niche!" And then I chanted,
Software's founder. Back then, I chased dollars. Today, Patriot helps you protect your dollars with simple accounting and payroll. No chanting required. Just go to patriotsoftware.com.
You know the feeling. It's 2 a.m. You're awake. Running the numbers in your head. Payroll's coming. A client hasn't paid. Costs just went up. And you're thinking, how am I going to make this work? That's where LendSeek comes in.
That was me. I had payroll in 3 days and money tied up in receivables. I couldn't wait weeks for a bank. I went to LendSeek, and within minutes, I saw real funding options. They were clear, upfront, no games. By the next day, the money was in my account. Payroll went out, crisis over.
LendSeek uses AI to match your business with the right funding, up to $5 million in as fast as 24 hours.
With LendSeek, it's not just funding. It's knowing you're covered when things get tight.
If you've been in business for at least 1 year with at least $500,000 annual revenue, apply today. No upfront costs, no prepaid penalties. Because in business, waiting isn't an option. Start ready, stay ready with LendSeek. Apply at lendseek.com. That's LENDSEEK.com.
Advantage Gold, America's #1 precious metals company, is sounding the alarm that a storm is coming and that now is the time to diversify your portfolio before it's too late. That's why we're offering an emergency gold and silver protection kit valued at $49, absolutely free for anyone who calls today at 800-900-8000. This kit includes critical information for investors with a retirement account seeking to own physical gold and silver but want to do it tax and penalty free. Advantage Gold has helped investors protect and secure their wealth with physical gold and silver since 2014. Call Advantage Gold now at 800-900-8000 and we'll rush your emergency gold and silver kit plus a free copy of Ken Rogoff's book, Our Dollar, Your Problem. See how gold and silver can help you protect and secure your wealth with the help of Advantage Gold. Results vary. Consult your tax advisor before investing. Call 800-900-8000. That's 800-900-8000.
My dad passed away unexpectedly. Of course, it was awful in every way, but we are very grateful that he had life insurance. So even after he was gone, he was still able to provide for us. And that's why I have life insurance for my family. Ethos.com. They make it fast and easy to get covered. It's 100% online. You get a quote in seconds. You can apply in minutes. You get covered the same day.
Get your free quote at ethos.com/apply. That's ethos.com/apply. Paid spokesperson. Time spent on application may vary. Online health questions required. Rates may vary.
Welcome back to Overtime. It's all pain and no gain for Planet Fitness today. The gym operator beating Wall Street's first quarter earnings estimates, but slashing its full-year outlook by more than half because of slower than expected membership growth. The company's CEO says affordability concerns are to blame for the weak signups. Planet Fitness shares now down roughly 60% this year. Interesting because the CEO also said that the environment is different. We're not going to push through this price increase that we were going to push through. So,
which had been the story, right?
Yeah.
You start really low in terms of the price point, and I guess obviously the first quarter is New Year's resolution season.
Exactly.
If they miss on that quarter in terms of membership growth, it's hard to kind of make it up. And I know that everyone's already kind of bracing for the GLP-1 effect, or maybe that it just sort of changes demand. But I don't know, at $9 or $10 a month, it's unclear if that's really the driver here.
All right, well, DraftKings first quarter numbers out earlier this hour. The stock bouncing around right now after beating on the top and the bottom lines and reaffirming its full-year revenue guidance. In April, the company saw its predictions consumer volume exceed $1 billion, an increase of more than 30% month over month. Joining us now in a first on CNBC interview before the earnings call is DraftKings co-founder and CEO Jason Robbins, along with our Contessa Brewer. Jason, great to have you with us.
Hi, how are you?
$1 billion is a big number. Can you walk us through where that $1 billion comes from? Because there had always been the concern that it could cannibalize the sportsbook business. So what are you seeing?
Well, we only operate sports predictions in states that we don't offer online sportsbooks. So it's coming from all those states. So it's entirely incremental. It's there's no cannibalization whatsoever.
And are these new customers, or are they other customers who place bets already with you?
You know, some of them are customers that had downloaded the app and used it when they were in a state that had legal sports betting, but many of them are new. Really, the big story for us in predictions is customer acquisition. The volume always lags that. You acquire the customers and then the cohorts produce. So we're actually really excited about what we're going to see in the coming years. You know, right now, customer acquisition's on fire, and we're not even in the busiest season yet.
In fact,
you reported that the customer acquisition costs in April dropped 80% because you put the predictions into this new unified app that sportsbooks and iGaming and all that. Are you seeing lowered customer acquisition costs in sportsbook and in iGaming as well?
So this is really specific to predictions where that big drop occurred, and it was because, as you said, we integrated it into the Super app, and that made a huge difference. What we realized before we did this was that the vast majority of customers, they don't know based on what state they're in which app to download, so we made it easy for them. We made it not their problem, but our problem to sort out on the back end, and it's all now in one Super app, so much easier for them to find, much more streamlined, and the CACs are plummeting.
Where do you think you are, Jason, in terms of just overall penetration, what the potential market is going to look like now that you do have, prediction markets that are obviously open in states that are not legal sports betting states?
Well, that's a great question. That's about 47% of the population, so nearly half of the customers that we could not reach with our sports betting product before. So, this is very early, year one of opening up many new states, essentially, and so I expect customer acquisition to grow substantially in H2 and then really continue into 2027 and beyond.
Can I make any predictions as to how big prediction market revenue will be as a percentage of total, Jason?
That was good. I like that. We'll see. I'm not sure. At this point, it's very early. We do think that it could be a very substantial TAM, though. We laid out some estimates for that in our investor day, but it's early, so I don't want to put out a number just yet. But we do think it could be a very substantial growth engine for us for many years to come.
Your competitor, Flutter, announced on Wednesday that they are getting into the market-making business. Talk to me a little bit about how you're thinking about predictions overall. This is up, sports part of this is really being contested in federal court. We all think it's headed to the Supreme Court. What do you do if sports are no longer part of the predictions picture?
Well, that's something obviously we're following closely, and it's not up to us. It'll be up to the courts to determine that. We're going to continue to operate in the environment that we're given, and it's always interesting in this industry with a regulated industry. There's always things that are changing, so we'll have to see how that plays out. But right now, as you mentioned, we are also in the market-making business. That's something that we launched several months ago, and we're making money in it, which is great for a new line of business. Usually it takes much longer to get to profitability. This was a much faster path than we're used to.
Jason, we talk a lot here about the growth of prediction markets business from companies that are otherwise in the investing or financial trading type platforms. And there's some discomfort, I think, with the way that prediction markets, largely sports, are right alongside of people's investments on a given app. I know you've always basically characterized sports betting as sort of entertainment consumption. Is there an issue for the overall prediction markets or a backlash potential based on those concerns?
Well, it's a great question. It's something we don't do. We have, all of our products are entertainment products, and that's how we view them, and that's how we market them. So I do think that's something people will pay attention to, and, we can only control what we can control, and I think we've really been the good actor in this space. There are a lot of things when you have a new industry where you see companies doing stuff they shouldn't be doing, and we've seen a lot of examples of that here, and I think DraftKings, given our track record of being a regulated, responsible operator, doing it the right way, having all the infrastructure for responsible trading, responsible gaming, KYC, anti-money laundering, everything that you would want, really positions us to be doing this in the right way, and I think we have so far.
Can you give us some color about the current quarter and the willingness of the consumer? We've heard so much about having difficulties, money's being tight. What is the cadence of their engagement on your app?
We've seen incredible engagement numbers, as evidenced by a great quarter. We beat top and bottom line estimates, really just strong performance, and it was all driven by the customer. We saw excellent customer engagement and continue to, do the things that we need to do to create a great experience for people, and I think it's starting to show. And I think the differentiators, we've had the number one ranked product for quite some time, and I think it's really starting to show up in our numbers that people are seeing a difference in the offering that we put out there versus some of the competition.
But it's been strong since the quarter closed? That's what I'm asking. The quarter that we're in right now.
Absolutely. Yeah.
Okay. Jason, great to speak with you. Thank you for your time.
Thank you. Appreciate it.
Jason Robbins of DraftKings and our Contessa Brewer.
Thank you, guys.
Up next, much more in today's big after-hour tomorrow's earnings movers as we count down to the analyst calls from Airbnb and Lyft, plus what to expect from tomorrow's April jobs report and the potential impact it could have on the markets. Closing bell overtime live from the NASDAQ market site. Be right back.
The 2026 Netflix is a Joke Fest is underway in Los Angeles right now, featuring some of the biggest names in stand-up comedy performing all week long. Can't be there? Netflix is a Joke Radio's got you covered. Hear interviews, live shows, and exclusive stand-up with some of your favorites. Plus, What a Joke with Tom Papa and Fortune Feimster are joined by guest host Eric Andre live every night. Netflix is a Joke Fest is on Netflix is a Joke Radio, Channel 93, and on the Sirius XM app.
At Janus Henderson Investors, we believe working together is the way to work better. Like combining your portfolio plans and our in-depth strategy, your valued assets and our valuable insights, your vision and our mission, working in harmony to seek the right investment opportunities. Janus Henderson Investors, investing in a brighter future together.
Hey, employers, quit being and consider offering an affordable medical plan. The Claim Doc Dual Option Approach. Wouldn't it be nice to offer a major network option for the executives who can afford higher premiums and deductibles while offering a significantly lower cost medical plan for most of your employees? Well, cheer up. Now you can. Ask your broker about the Claim Doc Dual Option Approach and stop being by offering a plan your employees can no longer afford. Visit claimdoc.com to learn more.
What does running your business feel like with Avalara, the agentic AI platform for global tax and compliance? You don't hover over the submit button. You don't ask for a second opinion. You don't wake up thinking about a filing. Because Avalara's agentic AI handles it. Calculating, filing, validating. With the accuracy and audit defensibility your team can stand behind. Avalara, agentic AI tax and compliance with confidence.
Is the person who manages your Google ads the best? Here's who Google thinks is the best. Google thinks it's Search Kings. Of more than 10,000 Google agencies in the United States and Canada eligible for the honor, it is one company, Search Kings, that is the winner of the Google Ads Impact Award, given to the Google partner with the most impactful Google advertising results. You want to stand out where your customers are online? Switch to Search Kings.
Wesley Financial Group is not a law firm.
I'm Chuck McDowell, founder of Wesley Financial Group. Did you buy a timeshare because they told you it was a great investment? That's a lie. Most timeshares can be bought online for $1. To find out what your timeshare is worth and to cancel it, call us today and we'll send you our timeshare exit kit free with all your options for cancellation.
Call Wesley for your free exit info guide. 800-691-9999. That's 800-691-9999.
Looking for comedy you don't have to skip around? Comedy in Full delivers full-length stand-up albums for smooth listening and continuous laughs.
Men aren't allowed to be sad. We're allowed to be mad or fine. That's it.
Streaming now on the Sirius XM app. Just search Comedy in Full. Shares of Iron soaring after hours on news of a deal with NVIDIA. The company saying they will work on data centers to combine NVIDIA's AI factory architecture with Iron's power and infrastructure operations. The deal also gives NVIDIA the right to buy up to $30 million of stock at a price of $70 a share. That could be an investment of up to $2.1 billion. Iron shares soaring to $68 after hours.
All right, well, let's get one more check on the earnings reports out at the top of this hour. Coinbase, Airbnb, and Lyft all missed estimates on the bottom line. Despite that, Airbnb managing a small gain after hours. Akamai making a big move higher, a narrow beat on earnings, right in line on revenue. Company also saying it reached a deal for cloud infrastructure services with what it calls a leading frontier model provider. Only a couple of those, I guess. Saying the deal could be worth $1.8 billion over 7 years. Cloudflare, another big mover, but to the downside. It beat on earnings and revenue, and its guidance is mostly in line with estimates, but says it will be cutting about 1,100 jobs. That's roughly 20% of the workforce. Those shares down 13.5%.
Well, let's get you set up with tomorrow's trade today. Wendy's is the only big name on the earnings calendar, but investors will be paying very close attention to the April jobs report. Non-farm payrolls seen rising by 55,000. the unemployment rate expected to hold steady at 4.3%. Economists predicting the unemployment rate to hold, as I said, 4.3%. Average hourly wages increased by 3.8% year over year. We'll also be on the lookout for the preliminary May reading of consumer sentiment. So this should be an interesting one. To watch.
Estimates in terms of the job growth has been creeping higher.
Yeah.
I think the ADP report being strong for private payrolls and just in general, sort of a firmness, lack of unemployment claims working through the system. And then the question is, how much is enough, right? I mean, 50,000 jobs is actually probably enough to keep the unemployment rate steady or have it go down. We've priced out Fed rate cuts, so I guess it probably doesn't have much of a potential to swing that out.
Oh, I was going to say less important perhaps than other jobs reports in the past, but still very interesting.
It feels that way, yeah. The labor market is not the front and center indicator in this particular moment in the cycle. All right, that does it for Overtime today.
Fast Money begins right after this quick break.
Accredited investors, tired of the stock market roller coaster? Want to hedge your bets and looking for a smart alternative to grow your wealth? Ascend Capital Partners offers a real estate fund with annual target returns of up to 18% with monthly distributions, an attractive alternative to annuities without high fees or commissions. The fund invests in luxury, residential real estate projects across the country, and its proprietary high-tech platform streamlines every project, shortening timelines and increasing profitability. With a $100 million plus real estate portfolio and significant tax advantages, this fund could be a smart way to hedge your bets while receiving reliable annual target returns up to 18%. To learn more, call Ascend Capital Partners now at 800-775-9550. That's 800-775-9550. Or visit investwithascend.com. Investors should consider the investment objectives, risks, charges, and expenses carefully before investing. Target returns are not guaranteed, and past performance does not guarantee future results.
You know the rush when you reach that goal, when something you've worked for pays off. That's success. At University of Maryland Global Campus, we believe you should never stop chasing it. That's why we offer a skills-based education that helps move your career forward. Learn how to apply emerging technologies like AI and data science. Build your leadership and critical thinking skills. Apply now and save with no application fee. Classes start May 13th. Learn more at umgc.edu. Certified to operate in Virginia by Shell.
If you're looking for the right franchise concept at the right time, say hello to Sparkle, not your average dog groomer. A new franchise concept that offers dog lovers quality, routine, and affordable care 7 days a week, and entrepreneurs the opportunity of a lifetime. Sparkle offers a strong, scalable business model that drives monthly recurring revenue and provides investors with the opportunity to take a bite out of a rapidly growing pet care industry. With over 300 licenses already awarded to our regional developers and franchisees, there's never been a better time to own a Sparkle franchise in your market. Prime regional developer opportunities and franchise locations are going fast. Invest in a Sparkle grooming franchise today and get full service support from expert franchisers who know how to make business a whole lot of tail-wagging fun. Have questions or want to learn more? Visit sparklefranchising.com today or give us a call at 888-600-4491. That's 888-600-4491. Or visit sparklefranchising.com. Sparkle, not your average franchise.
When it comes to business, CNBC is it.
From global market coverage in the morning to the latest market moves throughout the day.
Record-setting day on Wall Street, and it was the NASDAQ that did it.
Turn to the most trusted source for business news. CNBC, Sirius XM 112.
Live from the NASDAQ market site in the heart of New York City's Times Square, this is Fast Money. Here's what's on tap tonight. The true tale of the consumer. What the massive moves lower in Shake Shack, Planet Fitness, and pet med company Zoetis tell us about who is spending now and what it means for the economy and the markets. Plus a slew of after-hours earnings from semis to crypto, from travel to healthcare. We'll dig into the numbers behind all these moves and bring you the trades. And housing headaches, Whirlpool slashing guidance, and home builder stocks sinking. We'll talk to Zillow's senior economist about what he sees next for the industry and how much longer the pain could last. I'm Melissa Lee, coming to you live from Studio B at the NASDAQ. On the desk tonight, Tim Seymour, Karen Feinerman, Mike Coe in person, day 2, and Carter Braxton Worth. Stocks closing near session lows even after the NASDAQ and S&P hit fresh intraday records early in the day. And as we look under the surface, a couple of earnings reports paint a mixed picture for the consumer. First, there was McDonald's seeing a pullback in its lower-income consumer, who it expects to face continued pressure from higher gas prices. The fast food giant did beat first-quarter estimates, though, as it gained share among wealthier households, that coming at the expense of chains like Shake Shack, whose shares posted their worst day ever. Earnings, revenues, and margins all contracted in its latest quarter. The company pointed to weather disruptions, plus shrinking tourism in the U.S. and Middle East, with higher beef prices also having an impact. Consumers also don't seem to be trading burgers for healthier habits. Planet Fitness plunging over 30% to close at April 2020 lows. After cutting its full-year outlook, the company seeing slower member sign-ups and pausing price hikes for its higher-end Black Card plan. Even man's best friend is feeling the pinch. Animal health company Zoetis hitting levels last seen January 2019 after its report. The CEO flagging growing price sensitivity among pet owners who booked fewer vet visits and opted for lower-cost care options. And just yesterday, Kraft Heinz sounded the alarm on the consumer, saying shoppers are running out of money and dipping into savings in the current environment. So what do all these signs of the consumer mean for the macro picture? Tim, what are your thoughts here?
Well, it was 2 weeks ago we heard that Domino's actually told us that the consumer sentiment was at the lows they had seen in COVID. That sounded shocking, except when McDonald's says things are not improving and they might be getting worse. You combine that, we got a final Michigan consumer confidence that was at effectively record lows, back to 78 in the final print. We're back to hearing what, we love these special terms and phrases and metaphors. I mean, the K-shaped economy is very K-shaped, and Special K probably is next to tell us that. So, I mean, I think it's real. I think it's real, and I think the companies that have the ability to be resilient, like a McDonald's with their, the Super Mario meal you love to go out and buy, I mean, who doesn't? I mean, but in other words, they have ways to get around it and to actually price up a little bit. They're going into beverages, we hear. But there's no question, add in student debt. We heard from Warby Parker student debt. We've heard about unemployment that's starting to take place in lower income consumers, but also just call it first, second job out of the market. So there are different dynamics here. And what everybody says and seems to say is they think that their energy costs are going up at least another 50 cents to $1 in the next year. So people likely feel what the CEOs in the energy sector are saying, which is that you ain't seen nothing yet.
Yeah, I mean, gas prices above $4.50 a gallon at this point. Insurance costs are also up, which is weighing the consumer here, Mike.
Yeah, I mean, and in some areas, of course, gas prices are substantially higher than that. Right. I mean, I'm visiting. I live in California. Premium's more than $7 a gallon where I live, or at least it was when I left. It's probably closing on $8 by the time I get back. That's how fast it's going up.
Is premium 87, 89, or 90? Are you like a 94 guy?
That's 91. They don't have 94 in California because that's special formulations, which is another problem, actually, for them on the energy side. Well, they have proprietary formulations for gasoline. That's one of the reasons why the prices are so much higher there. But it's the most populous state, and it is a state that has a lot of drive-thrus. It is a state that is sort of known for fast food. And, the prices for many of these things had already gone up. So the consumer was being pressured by higher beef prices and all the rest of it before the gas prices hit. And that's the thing that has both the most immediate but also the most visible effect on consumers. It is something that is going to set them back a little bit. They look at it, they have shock.
Yeah. Karen?
So I think we're going to see more and more. I think it's not getting better, regardless of whether we're in a ceasefire or not. I think we're going to see this oil thing for a while. And I think there's the real K of it is, the top of the K, they're long stocks. So they feel very different than someone who is, really the percentage of their overall spend, which is spent now on gasoline, is relevant and expensive to them, where that same, upper end of the K who's in the market, not so focused, not so sensitive. So I think we're going to see things like we saw, I think, like for something like a Cava coming up in 2 weeks.
Yeah.
I think that will, we saw Shake Shack, and I think of those as similar.
Right.
Sort of the,
price point is higher.
Right. I think we'll probably see some pressure there. And I think, something like Tapestry, which traded, I don't know if we'll get to it later, I forget, I'm sorry if it's out of order. But Tapestry, I thought, wouldn't be the first time. All right, well, at least if your phone rings, then I'm totally out of it. But, so Tapestry, I actually thought it was sort of muted guidance. The quarter actually wasn't bad. But we haven't seen a quarter that really had a full oil move in it.
Right.
Only partially.
I mean, the real tell to what you're discussing, of course, is if you look at the equal weight S&P 500 consumer discretionary sector, which, of course, the actual sector Amazon, Tesla, Home Depot, 50% weight. But if you take the equal weight index and look at its relative performance to the actual, it's making 5-year lows right now, which speaks to under the surface, obviously Amazon's holding up well, so is Tesla generally. There are problems that have been going on for a while. This is not a new thing. Now, when you get these drop and gaps like the Shake Shack and others, it speaks to something that is not likely over.
I mean, what is going on in the market is very much what is going on in the economy, in that you have a certain sector that that stays strong and papers over the weaknesses in the other parts of the market, or papers over the weaknesses in the other parts of the economy. And so at what point do you start thinking, like, this setup is not healthy, and we're going to see it come home to roost?
It's great that the top line EPS for the market is going to have one of its best EPS growths after a very strong 25, and that's exactly, we've just come out of the period where you got all the gusto in there, and then I would just get back to parts of discretionary that really are the outer edge of the discretionary dollar and the place where things are tapped. And I go to athleisure, and I go to Lulu, and I go to Nike, and I go to these places that they're brand specific issues, but there's no question. At some point you look in your closet, you've got like 15 pairs of running shoes you don't need anymore. So I think we're in an environment where we are not even beginning to digest the impact of AI job loss. And I don't know what that means, and I know that's really, again, fed into the younger, call it demographic of people looking at that first and second job. A lot of them seem to be getting pushed out of the market here. We know that there's a dynamic where the Fed is not that worried about inflation, because they kind of haven't told you that they think that I might be putting words in the Fed here, but I think that there's some sense that the labor market could be softening. And if we get any sign of that, equities up 26% on the NASDAQ in 32 days, that's a little scary.
Well, you know what is interesting? I was looking at this earlier today with respect to the NASDAQ specifically, because that's basically the basket of winners. And I was looking basically at the price of 10% out of the money calls to 10% out of the money puts, and I was comparing that to how that was 2 weeks ago, a month ago, 2 months ago, and back on January 28th, which was the prior high before the February 28th strikes that took place. And what's interesting is that the bullishness in options for the NASDAQ index right now is higher now than it was in January at the prior highs. So, but look, 85% of the NASDAQ is those top 25 stocks, which is basically all the big trade right now except for Costco and Walmart, which is also in that basket.
Can I ask Mike a question?
Yes.
So that skew, is that just doesn't seem crazy to me. Is that a sort of historical high? I know it was higher than you saying January, but over the course of the market, in I don't know however long time frame you want to put.
Yeah, so there's a couple different ways to think about when you're looking at options prices, upside calls versus downside puts, and also where volatility is right now. So the way most of us think about concern and complacency, we look at something like the VIX index, and we can see that's come in. It's actually below the historical average for VIX over the longest period of time, probably 19.5 is what that is, but that includes a lot of really woolly periods in it. What we have right now is sort of mean volatility at the money, but it's the upside calls relative to the downside puts that are seeing that strength. So this is contextual the way I'm providing it right now, which is to say that we were pretty bullish in January, let's be honest, and it's more bullish now. That's kind of interesting. It's on the back of the earnings. That's the story.
Some new data gives more insight into the widening gap between high and low income households. For more on the K-shaped economic divide, let's get to Steve Leisman. Steve, what are you seeing?
Hey, Melissa, you have two studies looking at wealth disparities, one on wages, the other on gas spending, showing the K-shaped economy getting bigger and wider. Bank of America, the Bank of America Institute finding the wealthiest Americans enjoy much bigger wage gains than middle and lower income families on a consistent, and you can see their growing basis. That's that orange line there. The report, it comes from actual bank account data, found wage gains of 6% year on year for the highest income group, 1.5% for the lowest. B of A economist David Michael Tinsley says gap could be related to bigger bonuses, and also automation could be, you guys were just talking about this, could be undercutting the bargaining power of workers at the bottom edge of the wage spectrum. Meanwhile, on the spending side, the surge in gas prices hitting the poorest Americans, as you might expect, the hardest. The New York Fed finding that the wealthiest households, they paid more, but they kept their gas consumption the same. Low-income families, they cut back on their gas consumption to make ends meet. Overall, you can see here, real incomes adjusted for inflation have been negative in 4 of the last 6 months. Inflation taking a bigger bite from those paychecks. Meanwhile, Disney, Starbucks, GM, I looked at their reports. They said the consumer still looks healthy. Of course, Whirlpool saying appliance sales have fallen to recession levels. The head of Kraft Heinz saying today consumers are literally running out of money towards the end of the month. So I guess that's why you got the guys around the table, Melissa. They can figure out how to trade it.
Walk us through what the thinking is in terms of AI. AI has led to inflation in many different pockets of the economy. We see it in memory prices, for instance. We see it in electricity prices, which consumers are acutely feeling, and yet AI, in theory, should be deflationary in the long run. I guess there's a handoff period that has to happen.
Yeah, there's a transition period. There's two forces of, let's say, inflationary forces that come from AI. One is, I think, the one when it comes to the cost of capital. You're going to spend $1 trillion, you're going to really push up the demand for capital, and that raises rates. But there's another thing, and that's the equipment that you buy. And I'm looking now at this index we have, which is an index of inflation in equipment. And that's up like 5.7% in the first quarter on an annualized basis. And that was either negative or zero for much of the time before the pandemic. It popped up after the pandemic. It kind of came back down, but now it's popping up again. Melissa, there's a calculation I did. If you look at information processing equipment, it's up 33% year over year. But take that out of overall equipment spending, and it's just 3%. So it's all in the computer side, and that has an inflationary impulse before perhaps the productivity seeps in, and then you have a deflationary impulse.
Steve, if we think about the consumer and the inflationary impact, as you said, essentially, negative wage growth, are there any readings, is the Fed or any of the regional surveys giving us a sense of where this number is going? If we're extrapolating here, it's going a lot more negative. And what does the Fed think about that?
Well, first of all, it's Melissa's job to pick the winner of the segment, but it was Karen earlier who I would pick and put that on the... I would say when she talked about this idea that there's half of the country that owns stock and they're enjoying a wonderful wealth effect, and half of the country that doesn't. There's also a part of the folks out there that think somehow you can raise gas prices as much as you raise gas prices and not have any issue when it comes to the consumer. That stuff doesn't disappear. It's out there, it's going to affect people, and it's going to have a negative effect overall on spending, but it's going to be offset and probably then some when it comes to the upper income. So it's a very complicated situation. What I think the Fed is going to watch, Tim, is they're going to watch the job market. And if the job market keeps on keeping on, relatively low payrolls are needed to keep the unemployment rate unchanged in this immigration world that we live in right now. And so what you were going to get is if you stay and maintain a relatively modest unemployment rate, the Fed's not going to cut, not going anywhere, especially because of the upward push when it comes to gasoline prices and some of the other factors we've already talked about.
All right. Steve, thank you. Steve Leisman.
And Steve calling what we always should be calling. Karen's usually the winner around here. So.
Thank you. Thanks, Steve. That's just the way I wanted you to say it. Thank you.
By the way, don't miss Steve's interview with Chicago Fed President Austin Goolsbee tomorrow, 11 a.m. Eastern Time on Money Movers. And, of course, the April jobs report is going to be out tomorrow. So everybody's going to be watching that for any sort of evidence that the unemployment rate has budged, although that is not expected at this point.
No, I guess not. I mean, look, we're hearing a lot of grim stories. It was interesting. One of the things that Steve mentioned, he was talking a little bit about Whirlpool, and I just happened to be looking at that because that one traded a lot of options volume. This is just sort of a cautionary tale for investors in general because there are a lot of people who screen for stocks on things like PE. And if you screen for stocks on something like PE, you would find yourself saying, oh, I want to kick the tires on Whirlpool. I can pick this thing up at 8-9 times. This is really one of those things you have to be very careful of. This is a heavily indebted business. Things go south, and they're not going to have the cash flow. I mean, it's like 7 times debt to EBITDA, I think, is what it looks like right now. And that's one of the reasons that you see the options so expensive and so much volume, because the stock itself now has become an option on that capital structure.
We have some breaking news out of the Middle East. Let's get to Megan Costello with the details. Megan.
Melissa, we've been tracking reports this afternoon in Iranian state media of several explosions heard near a port city in southern Iran and at an oil port near the Strait of Hormuz. And now it appears that the United States was behind those attacks. That's according to multiple reports, Fox News cited a senior U.S. official who also told them this was not a restarting of the war or an end to the ceasefire. Now, I've gotten no immediate response from the White House on this, but it does come after attacks earlier this week on American forces protecting commercial ships in and around the strait and attacks on the UAE and Oman. Now, U.S. officials had been clear that the ceasefire was intact at the time. They said none of that rose to the level of resuming military operations. But then there was reporting today that U.S. allies in the Gulf weren't so thrilled about that. They felt like the Pentagon downplayed the strike. So now we see the U.S., according to these reports, returning some fire. Melissa, the question will be whether Iran will look to retaliate, whether they consider this a violation of the ceasefire, and then, of course, what this means for those peace talks. Melissa?
And what it'll mean, I mean, it seems like there's a wide band in terms of what can fall under ceasefire time, in terms of how many strikes can happen.
It's been so fascinating this week to see that. On Monday, we really saw a ramping up of the attacks, including at American forces that were protecting commercial shipping in the Strait of Hormuz, as well as at the UAE that had to activate its air defenses for the first time since the ceasefire had been struck. But then we saw very clearly on camera, on the record on Tuesday, a number of top Trump officials really downplaying that, saying none of that rose to the level of resuming military operations. So it is interesting now to see the U.S. wading back into this, perhaps trying to find some sort of a line where they say they're not resuming full operations, this isn't an end to the ceasefire, but also potentially satisfying allies in the Gulf who did want to see more action. So how will Iran respond? Do they also consider this doesn't rise to the level of resuming military combat? That's what we'll have to see next, I think.
Megan, thanks. Megan Casella. It's interesting because it seems like the markets will forgive all of this as long as the ceasefire is preserved, even if it's on paper. Then markets have permission to go higher.
Yeah, we're kind of semantically describing what falls as outside the, a bomb that falls or a missile that falls outside of the ceasefire. And by the way, I think everybody I think both sides want to do that, and I think we're going to continue to do that.
Asset manager TCW sees strong economic activity and is playing a key role in the firm's big bets on energy demand. Eli Horton is the senior portfolio manager of the TCW Transform Systems ETF, which is rated 5 stars by Morningstar. Eli, great to have you with us.
Great to see you. Thanks for having me.
This is interesting because you say we're basically witnessing the largest capital expansion in history. Capital spending cycle, whatever you want to call it, but this is it. This is the mother of all of them. How confident are you that every dollar of the cycle will be spent, and that we are not spending double dollars on chips or on different various parts?
I mean, I think you nailed the punchline. I do believe this is the largest capital cycle the global economy's ever experienced. That being the energy transition. I think there's 3 drivers of it. 1, energy security. These comments on the Strait of Hormuz really highlight how important energy security is. 2, rapid growth in electricity and power demand. 3, ongoing efforts to decarbonize our energy system. That's coinciding to be close to $5 trillion of capex by the end of this decade. It's close to that already. It's growing. It's structural. It's multi-pronged in its nature. So we're quite confident in the durability of this being multi-decade.
So, thanks for being here. With all of this money going in, it's hard to see that the return on capital will be good for all of it. Where do you think is the most vulnerable sort of sector of that spending?
Well, I can tell you the most topical piece, right? So energy security, I think we all acknowledge is important. That's an imperative for governments, for corporations. Efforts to decarbonize our energy system have been ongoing, will continue to be ongoing. Only more recently have we seen changes in electricity and power demand, so I think that's the place to start. If you go back from 1950 to the year 2000, electricity demand grew at about 5% per year, just under. 2 decades after that, from 2000 to 2020, flat. We're now growing again. Why are we growing? We're bringing manufacturing back to the U.S. We're electrifying our economy broadly, transportation, buildings, and then, of course, AI capex. That's the most topical place to raise questions, of course. We see a lot of durability there. You can look at the hyperscalers' earnings this last quarter. Microsoft Azure, Google Cloud, AWS, revenue accelerated across the board. They're seeing returns.
Eli, first of all, congrats on being early on a lot of these trades. I know this isn't just you catching up with the news flow, so that's fantastic. And I know core names have Caterpillar, which has had a monstrous run, GE Vernova. I look at Caterpillar on a 10-year relative P. It's trading 100 times its 5 years, trading 120 years times its 10-year. Have we priced in too much? I mean, I know this is a data center play. I saw it in some reports months ago. That makes a lot of sense to me. And I know earnings cycle right now is extraordinary, but at some point, isn't this just Caterpillar?
I think Caterpillar really epitomizes our thesis here, candidly. So you have essentially three lines of business. One's construction equipment, second is mining equipment, and the third is power generation. Yeah. Think about the past 15 years, maybe longer. Construction equipment, well, we moved a lot of manufacturing out of this country, so we certainly weren't building those factories. We went through a mining equipment super cycle that ended in 2012, so there wasn't a lot of demand for mining equipment. And we had that flat period of electricity demand I mentioned. There was a lack of investment in our grid. So Caterpillar faced 15 years of cyclical headwinds. That needs to be addressed. There's a lot of repairs and maintenance need to be done. And there's structural growth in all of its business lines now, and we're just seeing that
So
for a couple of
reference
years.
PE means almost nothing now.
I think you could argue that.
Well, that was
smart point.
I mean, basically, our historical PEs, historical valuations, you just throw them out the window because it's different this time. I mean, that's basically what the thesis has to be. I mean, you take a look at the gains in GSPro, which you own, and a lot of the cooling space. I mean, history doesn't apply here, does it?
History always applies.
Okay, so at what point then?
I would tell you it doesn't. But you have to be forward-looking. That's the market's trying to discount the future. We're trying to have a differentiated view on the future of the businesses we own. GE Vernova is a wonderful example. Nobody wanted a natural gas turbine for a decade. They were shipping 50% of their prior 10-year average. Now they're sold out to 2030. There's 3 companies in the world that make them. They have a lot of power at the table. It's important to recognize that.
Eli, great to have you here. Thank you for coming by. Eli Horton, TCW. What do these charts look like, Carter, to you?
Well, I mean, this is by Caterpillar. I mean, just 1 week ago, all the analysts that covered had a price target of 880. Stock is at 895. Now, of course, they moved the price target up after it beat, but the sell side doesn't believe it either, meaning taking the view that somehow history, this is too expensive. But it is just what Eli said. You've got to not use traditional models, and you have to sort of break your own rules and think, no, this is an exceptional moment in time. As to the chart, look, it's up and to the right, it's getting steep. And if I own it, I'd sell calls or take some other defensive measures.
I would imagine that it feels a little uncomfortable to say it should be different this time, and that this is a new norm.
I come up with a different phrase.
But think about how calmly and sort of deliberately he said it, right? Because he's done his work. That's what it appears like to me.
Yeah, you could have probably said that, or anyway, about GE Vernova hundreds of points ago, and left a lot of money on the table. So